In 2023, bad news was often good news because that meant the Fed was winning the fight against inflation. But with inflation moderating, could the terrible jobless claims numbers be a harsh reality check that comes back to bite us later on? With oil falling 5% overnight and factory production printing its 11th straight decline, today we discuss what happens when bad news becomes bad news. With technology making a new all-time high, are bullish investors getting too greedy, or will the euphoria continue? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. And it was a very mixed day today, just as it was yesterday. Yesterday's winners were today's losers. Pretty big selling in Walmart and Costco, as well as Microsoft leading the charge in the Magnificent Seven. But looking at the overall sectors, most stocks in the S&P 500 have captured their 20-day moving average, except for energy. Energy has really been lagging behind this entire market rally since November, and that's on the back of very poor demand. Crude oil fell 5% last night amid demand worries. WTI fell 4.9% and Brent fell 4.69% to 77.37 a barrel. And this sell-off has been driven by a lack of global demand. There is signs of demand easing in China. We know that China's economy is not looking the best right now, as well as the global economy as a whole. There's a lot of demand concerns in Europe too. And you also have a look in the US. We've had jobless claims. Jobless claims came in at 231, a very soft number, where the consensus estimate was 220. Pretty much demand in the US, North America, in Europe, in Asia is really waning, and that's having an effect on oil, and we're going to have to see how it affects the rest of the economy. So bad news could actually be bad news, and it could be a reality check that we have to face. That being said, we got the latest sentiment survey, and it was very interesting. It seems that the people in the middle became ever so slightly more bullish and ever so slightly more bearish. We saw that this number increased week over week, as well as the bearish print increased week over week. And we'll know that a market interim high has been put in when we see this bullish number right here get closer to the 1-year bullish high. When it gets to that 50% level, that's when you know an interim top has been put in. And you can see here with the bullish side, we hit the 50% mark on the 1st of November. And then from there, we saw a massive rip in the S&P 500. And the newest NAIM exposure index was released today. Funds in a very short period of time went about 22% equity exposure to around about 72. This is actually a very healthy number, because this survey can go well above 100 onto 200, and it could be leveraged long. So this still has room to run into December, into January, and all of this has led the market into nearly greedy territory. We're teetering just on neutral, and probably tomorrow, if we post a very flat day or neutral day, we probably shift into this greed territory looking at next week. And last time we hit greed was a year ago, 65. And all of this coincides with the S&P 500 being about 1.57% off all-time highs. Now this is the total return including dividends reinvested, and we are very close to new all-time highs in the S&P 500. And it's probably, and in total return and in total adjusted return, we probably are going to reach a new all-time high in the S&P 500 this year. And the biggest driver of this in the last 2 weeks has been treasuries. Treasuries have fallen significantly. There was a spike midweek, and you can see the 30-year is at 4.6% yield after it touched about 4.9 just 3 to 4 weeks ago. The 20-year is still a bit elevated, but the 10-year, 2-year really significantly come down from their highs of about 5.05%. And on this channel, we've said for a very long time that rates have peaked for the interim, and the latest Fed Fund futures data is now reiterating that. We are expecting about 4 rate cuts through to 2024 into 2025, and the first rate cut could come as early as March. A 30% expectation for a rate cut and a 50% expectation for a rate cut in May, and we are expecting a 25 basis point cut in March, and if we are to have the first one in May, a 75 basis point cut. And in 2024, it looks like we're expecting 150 basis points worth of cuts. And this is why investors are flocking to ETFs ETFs like TLT and look at the call open interest against the put open interest. Very, very large amounts of call open interest against puts. And if you stay until the end of the video, I'm going to show you some dark pool trades in the TLT, which investors are taking advantage of. Now, lower rates means higher bond prices, and this is the returns you can expect from bonds if rates are to fall next year. We are expecting about 150 basis points worth of cuts, and in the 20-year treasury, which is the TLT, you could expect an increase of about 26%. In the 30-year, about 33.5%. And obviously up to 300 basis points worth of cuts, you could expect a 50% increase. So very, very positive stats, and this is why investors are looking at instruments like the TLT and putting a lot of money into them. Now moving on, something that has flown under the radar is earnings. We've had earnings this week. We still are in earnings season, and Walmart reported earnings, often considered a barometer for the consumer, and Walmart absolutely tanked 8% in trade today. And this was on the back of what the CEO had to say, and he pretty much mentioned possible deflation in the coming months. Now pretty much this just means lower prices. This is great for the consumer. This is great for you and me when we go to the shops and buy our groceries. Now we are seeing early signs of inflation moderating, and you have to understand that all in all in the stock market, the best outsized returns come from inflation falling. Average annual return of about 14.7% when inflation has been falling, and this is data from 1928 to 2021. And you could see that raising rates is actually very positive for the market too, and it's about the same as falling rates. But the thing is, you have to be in the right stocks, and maybe we'll talk about the best deflation stocks to have in the weekend edition of the show. So go ahead and hit the subscribe button so you don't miss an episode. Let's talk about where to next, and this is the S&P 500 when we're up 10% or more at the end of June, and what we could expect for the rest of the year. I did post this exact chart on Twitter. This is the chart I posted, and it's the exact same one, and I posted this on the 28th of October 2023, and I said that stocks often bottom on October 27th. That's exactly what we saw. Now going back to this chart right here, this was the bottom we were talking about. This bottom coincided with the S&P 500's bottom, and we still are underperforming seasonality. But what about a pre-election year? Looking at this data for what we could expect for the rest of November, rest of December, we are expecting some form of a pullback into November, the start of December, and then the rally towards the end of the year. Now let's break down November explicitly. I showed you guys this yesterday, and I said we should see some topping at least for the month of November before we see some form of a pullback into possibly the 20th and the 21st, and in a pre-election year we could see a pullback to as far as the 24th. We're not going to play any shorts. I'm not taking any shorts here. We are holding our positions, looking for some form of a pullback that could occur between the 20th and the 24th. And this was our game plan that we've been following over the last couple of weeks. Essentially, we bought longs at key levels. I said to buy in my video on the 25th and the 26th of October. I said buy, and we're going to hold our longs until the 15th January or the 16th of January, which is the VIX expiration. And at the same time, we're building out our TLT longs, and we're looking for a low to occur between the 20th and the 24th of November, like we just discussed. We're going to add two longs, possibly QQQ and IWO. And if no low presents itself, we're just going to continue to hold. We're not taking any shorts. We're just playing the long game. It's done very well. And let's look at some key levels. Now, I posted this on Twitter too last night, and I said Vanna and Charm flows are leaving on Friday, which should provide a great entry point. 4411 is the sweet spot. As you can see right here, this is the 441 area. So this is where we could see the sell down at maximum occur, right to this level. It could occur, the sell could end anywhere in between here. This is just a maximum I'm looking at, and then from here we bounce all the way up, and it's going to be a very quick bounce when it does happen. Don't take this 441 level as the be all and end all. We could just rally from this level, we could rally from here. I'm just saying that we are positioned long and we are looking for a pullback into this area right here. That being said, if a pullback doesn't occur, we're long. We don't need to worry about that. That's what we're looking for now, and this is all just based on seasonality. So OPEX is tomorrow, and the truth is the index is probably going to do much of nothing. There is so much gamma sitting right here, and this is where we're sitting right now, that it's going to be very hard for the index to really move in either direction. We could also see here that tomorrow on OPEC, $473 million worth of SPY gamma is expiring, and once this expires, there's not going to be much dealer support in the market, and we spoke about this in yesterday's video. Vanna and Cham are pretty much on holiday. These dealer supporter flows from from pretty much the end of tomorrow all the way up until the end of the week, possibly the end of the month, won't be there. So the market will be able to move in whatever direction it wants. And that's where my 4411 target comes from. We get these flows back sort of towards the end of the month, week 1 and week 2 of December. And that's when the rally will continue. But let's have a look at some dark pools, guys. And this is the TLT. And we've seen some massive trades. We saw huge trades come in here and here, and we have since seen the TLT rally. And I do think this is probably going higher. And this is my thesis behind why I said we need to start building out our longs, because we also saw the biggest trade since inception happen at this level. A market maker or a huge institutional buyer was buying at this level, and he probably supported price right here. This trade right here was actually 5.26 million shares. Then we actually got another 5.2 million share trade right there. Probably means this short was closed. Now we're probably net long from here and here, as well as right there. So in my opinion, this looks very bullish, and we're going to keep a close eye on the 88.50, 89.25 level. These two levels right here are very key to hold if we do want to see higher price action. But this is just on the technical basis. We do know the fundamental outlook for the TLT for bonds as a whole into 2024. Again, we had a very huge week of data. We had CPI, PPI, retail sales, initial jobless claims yesterday. And tomorrow we just got building permits and housing stats, nothing too big, along with OPEX tomorrow and the amount of gamma sitting on the index. There shouldn't be much movement in the index. And if you've made it up to here, thank you so much, guys. If you like this video, please subscribe, leave a like, leave a comment, share this video with your friends. You know I love you guys.